Welcome back to the Pro Ticker Podcast. It's your Saturday morning edition covering major financial magazine headlines, everyone. I'm excited for another deep dive with you.
Absolutely. Let's get right to it. It's been a roller coaster of a week in the markets. We've got trade wars flaring up again. Gold is hitting record highs. And there are some interesting developments in Europe that might surprise you.
I was looking at this MarketWatch article about gold hitting those record highs. It got me wondering, is this a sign that investors are really getting spooked about a potential trade war? Or is there something else going on here?
Well, the timing definitely seems connected to President Trump's recent announcement about reciprocal tariffs. The Wall Street Journal covered that pretty extensively, you have to remember. When investors start to get nervous, they often flock to those safe haven assets like gold. And as we know, gold tends to hold its value during times of uncertainty.
So it sounds like the trade war drums are beating louder than ever. Bloomberg is reporting that China has already hit back with tariffs of their own on U.S. imports. What do you think? Could this tit-for-tat situation get out of control? Or is it just posturing from both sides?
It's hard to say for sure, but the rhetoric is definitely heating up. Bloomberg also points out that hedge funds are increasing their bearish bets on oil. That suggests they're expecting a potential reduction in demand caused by these trade tensions. And it makes sense when you think about it. Trade wars tend to disrupt those global supply chains, and they dampen economic growth, which ultimately could impact oil consumption.
It's amazing how these events can have such a ripple effect through different sectors. You mentioned oil.
Yeah.
But I'm also curious about the impact on individual companies. MarketWatch, for example, has a piece on Tesla struggling in both China and Europe, and they suggest that tariffs might be playing a part in that.
Oh, absolutely. Those tariffs make it more expensive for Tesla to sell their cars in those markets. It puts them at a real disadvantage compared to the competition. And it's not just Tesla. Many companies that depend on global supply chains and international sales are feeling the squeeze.
With all this talk of trade wars and economic uncertainty, it makes you wonder if there are any safe havens for investors. You mentioned gold, but are there any other bright spots out there?
Well, this might surprise you, but Bloomberg has an article highlighting a pretty big surge in European stocks. They're actually outperforming U.S. stocks for the first time in years.
Really? I always thought of Europe as kind of lagging behind, especially after the Wall Street Journal reported they ended 2024 with zero growth.
I know, right? That's what makes this surge so interesting. The Wall Street Journal attributes it to a few things. Things like cheaper valuations, improving profit growth, and a weaker dollar, all of which benefits European exporters.
So are European companies suddenly becoming more competitive? Or are investors just looking for bargains in a volatile market?
It's probably a bit of both. The Wall Street Journal also mentions there's some optimism about the possibility of more aggressive interest rate cuts by the European Central Bank, which could really help stimulate economic growth.
That's interesting. So someone was looking to diversify their portfolio internationally. Would you say now is a good time to look at European stocks?
It's definitely worth considering. Specifically, companies like Societe Generale and Banco Santander in the financial sector, and those luxury goods giants like Burberry and Richemont, they're showing really strong performance according to the Wall Street Journal. But, as always, it's important to do your own research and think about your risk tolerance before making any investment decisions.
That's good advice. While we're on the topic of stocks, the Wall Street Journal has an article that raises concerns about the growing concentration of power in the U.S. stock market, specifically among what they call the Magnificent Seven tech giants.
Yeah.
Is this something investors should be worried about?
It's definitely a trend worth watching, historically. A high concentration in the market hasn't always been a red flag. However, Bloomberg has this fascinating analysis that suggests AI advancements, particularly the rise of DeepSeek, could be contributing to this wave of concentration, and that does raise concerns about potential overvaluation in the tech sector.
So could we be heading toward a situation where a few AI-powered companies dominate the whole market? That sounds a little like science fiction, doesn't it?
It might sound far-fetched, but it's not totally impossible. What's interesting here is that while AI can definitely drive innovation and create new opportunities, it can also potentially make existing inequalities even worse.
That's a sobering thought. And speaking of potential market disruptions, MarketWatch has a piece on Tesla facing headwinds, not just in the U.S., but also in China and Europe. They talk about increased competition. And surprisingly, some potential image issues stemming from Elon Musk's political stances, especially in Europe.
Yeah, it seems like Tesla is facing a perfect storm of challenges. You've got traditional automakers ramping up their electric vehicle offerings, and companies like DeepSeek potentially disrupting the industry with their AI-powered solutions. It's a good reminder that even the most innovative companies aren't immune to market forces and changing consumer preferences.
So what does all this mean for investors? Is it time to ditch Tesla and jump on the European stock bandwagon? Or are there other things to consider?
Well, before we jump to conclusions, let's take a look at what hedge funds are doing. Bloomberg highlights Elliott Management's stake in Aspen Technology and their pretty aggressive push for a higher takeover offer from Emerson Electric Co. It's a classic example of an activist investor strategy in action. It shows how much influence hedge funds can have in deal negotiations.
And speaking of hedge funds making moves, Bloomberg also mentions Bill Ackman's recent investment in Uber and his surprisingly optimistic outlook for the company. Didn't Uber have a rough couple of years?
They definitely did. But Ackman believes they're turning things around. And his investment has definitely made an impact. It's pushed Uber's stock price higher. This is a good example of how quickly investor sentiment can shift, especially when a big player like Ackman makes a bold move.
So we've got trade wars, surging gold prices, a surprising European stock rally, and hedge funds shaking things up. It sounds like a lot for investors to digest. Where do we go from here?
Well, there's a lot more to cover. And I think it would be helpful to look at some specific examples of companies facing tough choices in this crazy environment. Would you be interested in diving into Microchip Technology's decision to maintain its dividend despite declining sales?
Absolutely. That sounds like a risky move. Let's explore that further.
Yeah, you're right to be surprised about Microchip Technology. MarketWatch is reporting that even though they're dealing with declining sales and a tough business environment, they've decided to keep those dividend payouts steady.
It does seem counterintuitive. Why would a company borrow money to pay dividends instead of cutting them, especially when sales are shrinking?
Well, their reasoning, as
Yeah.
explained in the MarketWatch article, is that they believe this is just a temporary cash flow problem. They think cutting dividends would do more long-term damage to investor confidence.
So they're basically betting on a rebound, hoping to ride out the storm and keep those income-focused investors happy. It's a gamble, though, isn't it?
It is for sure. The MarketWatch article includes some opinions from analysts, and it seems like they're divided. Some are praising the company for their dedication to shareholders, while others are questioning if this strategy can really work. Especially considering the uncertain economic outlook, it's a pretty big contrast to what Intel did. As Bloomberg reminds us, they actually slashed and then eventually suspended their dividend.
That's right. Intel's move really shook things up. It seems like dividend decisions are becoming a major sign of a company's health and future prospects. But while we're talking about companies trying to navigate these tricky waters, let's not forget the bigger picture. Bloomberg reminds us that even with the markets reacting to all these events, the U.S. Treasury is busy taking those extraordinary measures to keep paying government bills, in the middle of that whole debt ceiling debate.
Yeah, it's a constant balancing act. That debt ceiling debate always seems to be looming over everything, creating all this uncertainty and potential volatility in the market. And speaking of volatility, we can't forget about the upcoming U.S. payrolls report. Bloomberg is suggesting this report could be a key indicator for where interest rates are headed.
It does feel like every piece of data is being scrutinized for clues about the economy's direction. So the payrolls report is strong. Does that mean we should expect more interest rate cuts?
It's definitely a possibility. A strong report could be a sign of a robust economy. It would give the Federal Reserve more room to keep cutting rates and encourage growth. On the other hand, if the report is disappointing and suggests a weakening economy, those worries about inflation might come back, and that could slow down the rate cuts.
Seems like we're always teetering on the edge, waiting for the next economic indicator to push us in one direction or the other. And it's not just the U.S. dealing with this. Bloomberg also mentions the Bank of England's recent interest rate cut, highlighting how interconnected the global economy really is.
Exactly. What one central bank does can ripple across the entire world. Take Volvo Cars, for example. The Wall Street Journal reports that they're getting ready for a bumpy 2025. They're citing three major challenges: ongoing tariff concerns, increasing competition from Chinese EV makers, and potential policy changes in key markets.
Wow. Talk about a tough situation. It seems like every company, no matter how big or small or what industry they're in, is facing its own unique set of obstacles in this rapidly evolving environment. There are so many interconnected factors at play, from trade wars and AI advancements to corporate maneuvering and government intervention. It's a lot to take in.
Yeah, it really does feel like we're living in a time of constant change.
Well, that's the market for you, always moving and shaking, reacting to every bit of news and every shift in sentiment. But that's also what makes it so exciting. There's always something new to learn and analyze.
I completely agree. It's a never-ending learning process. So for our listeners who are trying to make sense of this crazy week, what are the key takeaways? What should they be focusing on as they navigate this financial landscape?
Well, the first takeaway is probably the most important. Volatility is just part of the game. Don't freak out when the headlines are screaming about trade wars or market concentration. Instead, take a deep breath and try to understand the forces that are driving these events. Exactly. And as we've seen today, events that seem totally separate can actually be connected in unexpected ways, like how the trade war affects gold prices, which then influences investor behavior and ultimately impacts stock values across sectors and even continents.
Absolutely. The second takeaway is that staying informed is crucial. Pay attention to economic indicators like that U.S. payrolls report we talked about. Keep an eye on how central banks are responding with their interest rate decisions, and watch corporate earnings to see how these global events are actually playing out.
And diversification is key. It's easy to get caught up chasing the hottest stock or sector. But as we've seen, even the most successful companies can hit unexpected roadblocks. Don't put all your eggs in one basket, especially in a market where a few big players can really swing the entire index. Explore different sectors, look at international markets like we discussed with that European surge, and maybe even consider alternative investments like gold if you're looking for a safe haven.
That's a great point. A diversified portfolio can really help you manage risk and weather those market storms.
Okay, I have one final question for you before we wrap things up.
Yeah.
What's the one big question our listeners should be thinking about as we move forward? What's that underlying trend that could really reshape the investment landscape in the coming years?
For me, the big question is how the rise of AI and its potential impact on market concentration will shape the future of investing. We've already seen how AI is driving valuations and creating winners and losers. But what if this trend continues? Will a handful of AI-powered companies end up controlling the entire market? Or will we see a push towards decentralization and a more balanced distribution of opportunities? It's something to think about as we move into this new era of technology and finance.
That is a fascinating question to leave our listeners with. It seems like the future of finance is intertwined with the evolution of AI, and that's the discussion we'll need to continue having.
Definitely. And I encourage everyone listening to check out the articles we've been talking about today. You can find them in MarketWatch, Bloomberg, and the Wall Street Journal. They offer a lot of great information and different perspectives on these complex issues.
Well, that's all the time we have for this week's deep dive into the market's ups and downs. Hopefully, you've learned something new and have some things to think about.
I hope our listeners have a better understanding of how interconnected the world really is and how important it is to stay informed and be able to adapt in this constantly changing financial landscape.
Thanks for joining us, everyone. We'll be back next Saturday morning with more headlines from the world of finance. Until then, stay curious, stay informed, and stay ahead of the curve.